Hello, this is Nick Rach with the Earnings Scout, and I'm going to review fourth quarter 2016 earnings guidance here in third quarter earnings season. And what we've seen here, we want to give you the scorecard for the third quarter real quick. We have 34 companies in the S&P 500 that have reported as of October 17, 2016. What we're seeing is 79% of them that are beating their lowered third quarter 16 estimates. On the aggregate earnings growth from last year, up 9.2%. So how does that stack up to prior periods for these same 34 companies? What we're seeing is that the rate of growth that these 34 companies are reporting here in the third quarter 16 reporting season is better than what they reported in the second quarter 16 and in the first quarter 2016 earnings season as well. So the 34 companies, what we're noticing is growth is modestly re-accelerating after decelerating throughout 2015. This is something that we forecasted back in March when we upgraded stocks from our bearish stance to neutral. A lot of bears will then comment to us that say, hey, it's just earnings per share accelerating because companies are doing share buybacks. But we'll show you sales growth is also re-accelerating for these first 34 companies on the clock. We think they will be a reflection of what's going to go on throughout earnings season as well. And as we look at this, we want to tell you not to get excited because growth is re-accelerating. This has been priced into markets since February 2011. This is why the S&P 500 is up over 16%. Small cap stocks, as measured by the Russell 2000, up over 27%. And it's not just in the U.S. Developed international stocks are up 12%. And emerging market stocks have really caught fire in 2016. They're up over 30% off their lows in mid-February. Now, third quarter earnings, we said, are backward looking, and the growth, this acceleration of growth has already been priced in. Here's the most important scorecard of third quarter earnings season. We take a look at the Earnings Scout, the fourth quarter 2016 earnings guidance scorecard. So as companies report, these 34 companies report their third quarter earnings, we take a look at where their estimates for the fourth quarter, next quarter, were beforehand, and then how they changed after, and then measure how they're moving across after the report. So what we've seen is 62% of companies that are reported, of these 34 companies, have lowered their earnings expectations for the next quarter on average by minus 1.11%. Now, before you get too bearish here, realize this is going to be the 22nd quarter in a row where in the aggregate S&P 500 earnings estimates are going lower after companies report as opposed to higher. It's been since the first quarter of 2011 is when we saw net aggregate earnings going up on an absolute basis. So what we've been saying is less bad has become the new up when it comes to earnings estimate revisions. So these numbers by themselves, they're static numbers, don't tell you the picture of whether the earnings estimate trends are getting better or worse. Now we're going to show you what's been going on over the past year to the overall rates of change to S&P 500 earnings expectations. This is not just the Q1 or the next quarter estimate change. This is multiple quarters out into the future, multiple years out into the future that we use in a proprietary blend that we measure across multiple time series to see how overall earnings expectations are moving. So in peak third quarter earnings season last year in 2015, earnings estimates were coming down for the average S&P 500 company at a rate of 2.75%. Now, as we show on this line here, after peak earnings season, the line drifts back up, and you see it almost goes up to 0.84 here on the screen. That doesn't mean earnings estimates are now suddenly getting better and they're going up. It just means through the passage of time, we get no more revisions. Companies tend to report in a very tight period, and all of them tend to report at once, and that's when the revisions come in. So what we're looking for is in peak earnings season, whether there's lower lows or lower highs or higher lows. All of those factors. And what we saw here in fourth quarter 2015 earnings season, estimates are coming down at a rate of minus 3.98%. So you can see here, earnings trends were deteriorating between third and fourth quarter earnings season last year. This is why stocks struggled so much out of the gate in 2016. Negative delta, negative rate of change to earnings estimates, negative stock prices. That's what we can show. It's not the fact that the estimates are going down. They were going down at increasing rates. That's what made them bad. Now, estimates have been falling all throughout 2016. We just showed you that with our fourth quarter guidance scorecard. But what we see here in peak first quarter earnings season, the estimates are only falling by a rate of minus 1.54%. And then our proprietary measurement in the second quarter peak earnings season at a rate of minus 1.32. So why are stocks rallying in 2016? Positive delta to the earnings expectations. Estimates are coming down at less negative rates. So this is where the less bad is the new up, if you will, over the past 5 years. So where are the expectations currently falling at right now? Now they're falling at a rate of minus 0.34%. So before you get too excited about that, realize we are not in peak earnings season yet. Only 34 companies out of 500 have reported so far. As more companies report, and we're about 2 weeks away from peak earnings season, that's when we're going to get most of the revisions that come in. And when we look at where the current bogeys are, let's take a look. So we have all these negative earnings growth, weak or negative earnings growth for 2015 and 2016. The bogeys for the future, for the fourth quarter and beyond here, how are those estimates going to be met? And we look and see just a rapid reacceleration of growth anticipated by Wall Street. These are the consensus growth estimates. Pretty high. So when we look at the hurdle rates that companies had to clear last year at this time and even in earlier 2016, we had a low bar. In the weeks and months ahead, the expectations for earnings growth, as you could see, the rapid reacceleration that was anticipated for the fourth quarter 16 and first quarter 17 numbers, very high hurdle rates for companies to clear. So what we're anticipating is this improvement in underlying earnings estimates, where they were falling at lesser and lesser rates, should give way to the estimate trends turning south as companies report here in the weeks ahead. Now, if we are wrong and the estimate trends stay on an improving path, they can stay on this improving path right here. If that is the case, the market's going to be off to the races, in our opinion, because that means growth will rapidly reaccelerate into the first half of 2017. We'd be very happy to see that. We think that's unlikely. The more likely event is the estimate trends turn south here, particularly if the Fed is going to tighten with an interest rate hike and the potential for an ECB taper of its QE bond buying program. We get more companies reporting this week. 85, in fact, in the S&P 500 are set to report this week. We're not even going to look at what their third quarter numbers were, but the most important thing is we're going to look at their direction of their fourth quarter estimates and beyond, and to see if they're getting better or worse. We'll keep updating you as those come in. Right now, we have a neutral view on equities, a view we've maintained since March 2016 when we upgraded stocks from our bearish stance at the beginning of the year, because we saw that the growth was set to modestly reaccelerate. What we're going to see here, though, our finger's more on the trigger to sell at this point, because we think the likely scenario is the deltas to those expectations turn south. So as more companies report, we'll see if that's going to hold true. And if they do start to deteriorate, we'll be the first ones to start measuring that. And then warning our clients about that. So if you want more information on the Earnings Scout, you can contact our sales and marketing team at the contact information on the screen, or you can reach us at support@earningsscout.com. And if you're learning more, if you're not a client yet, and you are interested in learning more and want to do a complimentary trial, you can reach us at sales@earningsscout.com as well. So thank you for listening. And again, we're going to keep updating all of our clients on whether earnings estimates trends are set to deteriorate, or if they can continue on that improving path. So the jury is still out, and as we get the more data, again, we'll be the first to tell you. Thank you for listening, everyone. Goodbye.